Hello everyone and welcome back to the Velocity channel where we teach the Velocity banking method. And today, thanks to Jesus, our commenter, the guy who's been with us from the beginning, right? More than a commenter, he's a moderator, all right? And definitely an example. We're going to be bringing to you Velocity banking and adjustable rate mortgages, all right? And interest-only mortgages. And we're going to see how the Velocity banking method can work together with these strategies, all right? But before we get into that complex subject, but it's going to be real simple, all right? I want you to like, I want you to share, I want you to subscribe if you haven't subscribed, all right? Share this all over the world because everyone all over the world needs to implement the Velocity banking method to increase their bank accounts and their economy. All right, folks, it works. What works for one can work for the majority. All right, so look, I know that some of you took a sigh because I mentioned adjustable rate mortgage, maybe because of what happened back in 2008. But listen, in this video, I'm going to explain how these financial strategies can work together to help you actually save money, all right, and reduce that debt much faster. First of all, you already know about the Velocity banking method, so we're not going to take time to mention that definition, all right? What we want to get into is what in the world is an adjustable rate mortgage, right? What in the world is an interest-only mortgage? And how in the world is Velocity banking going to help us with that? So first of all, adjustable rate mortgages, it's a type of mortgage where the interest rate can change over time, typically after an initial fixed rate period. So let's say you got a 5/1 adjustable rate mortgage. All that means is the interest is fixed for the first 5 years and then can adjust annually. The initial interest rate on that arm is usually lower than the interest rate on a fixed rate mortgage, which means your monthly payments may be lower. Now, what's an interest-only mortgage? Well, that's a type of mortgage where you only pay the interest on the loan for a specified period, typically the first few years of the loan. Now, this can lower your monthly payment in the short term, but it also means that you're not paying down the principal. Okay, now, how are these strategies going to work together? We're going to show you that. Okay, so let's say you have a $300,000 mortgage with a 30-year term and an interest rate of 4%. Right? To implement the Velocity banking method, right, you know what you have to do to the principal. You got to chunk that principal, right? So you're putting it towards the principal and you're also paying it each month. Now you can make that regular mortgage payment if you'd like, but you don't have to. Now, let's add an arm to the mix. After 5 years, that interest rate on the arm could adjust up or down based on market conditions. So if the rate goes up, your monthly mortgage payment could increase. However, if the rate goes down, your monthly payment could decrease. Now, let's add on top of that the interest-only mortgage feature to that arm, right? You only pay the interest on the loan for a specified period, typically the first few years of the loan. And this can lower your monthly payment in the short term, but it's going to mean that you're not paying down the principal again. So, how are we going to do it? What are we going to do with these payments? Are you ready to find out? I'm ready. Let's hop. Well, would you look at that? We have an example of a $300,000 house at 4%, and all you would need to do is put that inside of your HP 10B2 calculator and calculate that out for the monthly payment of $1,432.25 per month. But that's only going to be for the first 5 years. So that's a fixed interest rate for the first 5 years, because remember, you have an adjustable rate mortgage, all right? Meaning that they can go up, they can go down, all right? Now, folks, if you don't have a plan in place, please don't go on the roller coaster. Does that make sense? Let's know the path first. I'm not saying don't ever do it, because sometimes they work out great, sometimes they don't. But please, please, please get connected, get with us. Let us know what you're doing, where you want to go, and we will absolutely help you get there. There's a lot of people actually that's getting great funding. And they even, are into settling debts. If they want to settle the debts, that's good too. We do that as well. All right. Look, 1432.25 per month. Okay, but that's for the first 5 years, folks. Okay, Now that interest rate could go to 5%. It could go to 7%, or it could go to what, 3.5%. It all depends on the environment, all depends on the lender, what they're doing. All right. So really the best thing to do is get a first lien HELOC. But I mean, if you need help with that, of course, we'll help you with that. But if you're in this situation, okay, and you want to stay there, that's great. Okay. Let's say you want to say, you know what, let me add on top of this. Right. And I already know how to chunk the principal, CJ. I've got my lines of credit over here. Let's say it's 15K in lines of credit over here. I'm not afraid of the credit utilization factor. I want to go ahead and get the 10K, and I want to strike this principal, CJ. So what are you going to tell me, right? So what if it's interest, right? And I'm not paying the principal. Guess what? I'm knocking down the principal with my lines of credit. Well, good for you. All right, good for you. Just realize that plans are very important, and that the interest, right, on the first month is going to be $1,000. So $1,000 is going to the interest. And you say, hey, you know, I only want to do the interest only loan. Okay, you'll pay about $1,000, let's say. Okay, estimated. You'll pay about $1,000 this month. You'll pay about $998 the next month, or, you know, somewhere equivalent to that each and every month. Remember, the principal is not getting paid. It's nothing's going to the principal. Okay, so what does that mean? That means it's looking really good for the banks, is what that means. Okay, now if you have a plan, I'm telling you, it's all about the plan to do more with that principal amount, that $489. Maybe you want to go invest it somewhere else. Maybe you need the cash flow to go, I don't know, on vacation somewhere. All right, you can do that. Right? Just know that with the velocity banking method, you're going to be hammering away at the principal. That is like the core of the velocity banking method, hammering this principal down. Because when you spend the 10K from this, and this right here goes to 290, let's go ahead and write it on top here, 290K. What is the interest on now? What is it feeding off of? It's going to be 4% of what? 5% of what? 7% of what? A lower principal amount. That's beautiful, isn't it? Oh, yeah. And so you're going to continue to pay those monthly payments, whether they're interest only or whether you just wanted to go with that adjustable rate mortgage, right? Now, let's say it goes all the way up to 12. Let's go all the way up to 20. 20% amortized. Folks, if you are implementing the velocity banking method and you are taking the line of credit and hammering away, come on now, you're hammering away at the principal, okay? Let's say another 10 grand goes in there. So now it went from 290 to 280. Now it's just 20% off of 280. But the key to remember is that it's going down. How are you paying your line of credit off? By the cash flow that stays in it. That's really all you have to be concerned about. Did you know that? I said the line of credit is all you need to be concerned about. Why? Because you're chunking from the line of credit onto the principal payment. Okay, great. Right? And you're making your monthly payments. That's great too. It's in the budget. It's a fixed amount. It's coming out every month. But because you're hammering away at this principal, guess what's going to happen? The amortization tables aren't going to do like regular people's. You see, the amortization tables, they only go down, what, $2 each month? If that, maybe $1, maybe $0.25 each month. While with you and your line of credit, you're chunking principal. Remember Janet Jackson, that song? It's the chunking principle that you are implementing to make sure that this amount goes all the way to zero, so that it doesn't matter what this amount is, 4%, it could be 40%. I got to get you guys out of the mentality of always looking at the interest rates. Okay, interest rates are interesting. Those that don't understand interest pay it, and those that do earn it. Okay? And that's what you'll be doing when you utilize that line of credit, when you utilize that checking account, that savings account the correct way, making sure that it goes to the principal and making sure that you're making your monthly payments on time. Okay? Because remember, this percentage right here, whatever it is only going to be a percentage of the principal. But if the principal goes down, it's a denigrating percentage. Okay? It's a denigrating amount that you'll have. So, folks, I hope this helped. I didn't want to get too far into the weeds on that interest only and adjustable rate mortgages. But just remember, as long as you're paying the principal, okay? Yes, hey, let's say it's a high interest rate. Don't beat yourself up. It's going to be a high interest rate on a disappearing principal. Remember that. God bless y'all. You have a good one. Take care.